Hey, what's up, everybody? It's Paul Olbrandt, your Friday weekend in rates. How's everybody doing? Happy Friday. Hope you had a wonderful week. Getting ready for the big weekend. We have a lot that we're going to talk about, including we're going to talk about the Feds, what just happened, and how it impacts 30-year rates. And I'm going to answer or attempt to give you the best advice I can to the most common question that I'm getting this week is, should I lock my rate? Should I refinance? Or should I wait to see what happens to interest rates? So with that, what do you say we get started? So let's go ahead and bring up the rates. Oh, wait. Hang on a second. Pow, there they are. So here's the average rates that's going on in the market today. If you take a look at my rates, they're still better than the average rates. Just saying. What we're seeing is that continued trend where it's a little bit, smidge bit better than last week, but nonetheless, it's still just a little bit better. I'm talking like 0.01%. So essentially, they're exactly the same. Okay. So a lot's happened between now and then. But here's the deal. Here's one thing that I want to share with you. If your rate that you're either being quoted on a purchase or if you're sitting on a home that you purchased and your rate's 7 and up, man, we got to talk. All right. Nobody, perhaps maybe if you're, I don't know. Let's just put it this way. If you have a 7 and up percent, you see that QR code just on the other side there, you got to scan that and pick a time that's great for you. And good old Paul is going to give you a call and we're going to try to save you some money. What does that sound? So what happened this week? Jerome Powell, the Feds, they lowered short-term interest rates, the Fed's fund rate, by 50 basis points. They expect another 50 basis point reduction this year and perhaps another 100 basis points next year. Now that we know that, the bond market, which controls 30-year fixed rates, already has that built into the price. So the only way the Feds can impact 30-year fixed rates is if they do more or less than what they say. Because remember, we are looking, the bond market is so focused on inflation. If there's any doubt that inflation is not under control, you're going to see interest rates rise. If there is a perception that inflation is coming down, you're going to see interest rates decline. That is the easiest, simplest way that I can put this. So here comes the question. After the 50 basis point reduction by the Feds, what happened to 30-year fixed rates? Well, shockingly enough, they actually went up just a little bit. It was crazy. Everyone was hoping that they'd get that 50 basis point reduction, not knowing what the Fed actually controls. But now you know. And by the way, your credit card statements, your short-term loans, your home equity line of credits, those are going to be impacted by what just happened. So here comes the question. Should we lock or should we not lock? Should we ride this out? When should we take advantage of these rates? Well, this is what I like to tell people. We are one event away. Well, let me take a step back even further. I do believe, given what I know today, that interest rates are going to continue their downward trend. However, it's very important to know two important things. Number one, we are one event away from interest rates changing their course. I don't know what that event is going to be, but I can tell you there's going to be no warning and it's going to come and that's going to redirect rates upward. Number two, the second thing I know is that when rates do go back up, you're just not going to get a warning. It's not like we're going to get a 2-3 day bell or email that says, hey, in 2 or 3 days, rates are going to go up, so you should lock. This is the best it's going to get. That's not how it works. So here's something I want to bring to your attention. This is serious. This is something that could be that one thing that gets interest rates back up right here. Longshoremen at key U.S. ports threaten to strike over automation and pay. So what does that have to do with 30-year fixed rates? I'm glad you asked. That's a great question. So think about this. If 30-year fixed rates are very focused on inflation, they're inflation driven. If inflation goes up, you're going to pay a higher interest rate. If inflation goes down, you're going to pay a lower interest rate. If goods and services cannot come into the U.S., that's going to take away a supply. That's going to limit the supply or shrink the supply. If the demand is still there, what's that going to do to prices? Prices are going to go up. If prices go up, inflation goes up. Yeah, you got it. 30-year fixed rates are going to go up. So this is a type of event that can happen out of nowhere that nobody's paying attention to. Well, I'm sure you're paying attention to this, but not as it relates to interest rates, that can directly impact your buying power. So, the last thing you want to do is get greedy and try to time it. My suggestion is if you're refinancing, lock what you got. If it makes sense, take the savings. If rates continue to drop, we're going to refinance you again. We're going to pay your lending fees and your appraisal. We're going to make it really simple for you. If you're buying a home, just lock. You don't want to get caught in this upward trend or get locked, and just know that you're probably going to refinance in 6 months to a year anyways. So it's all good. But that's my best advice for you as it terms to what that question is going to be about. Should I lock or should I not? All right, let's bring up home builder sentiment. This is important because, of course, we need more houses for people to buy. And anything below a 50 or 49 and below, the builder's feeling is negative, right? Or 50 or above, they're feeling positive. They're going to build more. Well, for the last couple months, they have been in the pessimistic, but that's because, right, interest rates have been so high. Let me just make this a little bit bigger for you here. But builder confidence rose 2 points to 41, which is great, with the future expectations component jumping to 4 points to 53. Remember, greater than 50 is bullish outlook as mortgage rates continue to drop. That's very optimistic for the housing market, because we need more houses. We don't need lower rates. We need more houses. Lower rates will definitely help, though. Housing inventory, active listings. So here's the deal. Yes. There's more listings out there, but however, we are so used to having such limited inventory. If we see 2 houses on the block for sale, we think this is the end of the world. We're not even yet. Take a look at the chart here. In August 2019, the active listings was 1.24. Now, in August 2023, it was down to 670. Now we're at 909. So we're almost back to normal, but we're still not at normal supply of houses. So there's still that quote unquote shortage of housing out there, even though there's a perception that there's more houses being sold. It's just not, we're just not used to it. That's just kind of how it is, right, you guys? Existing home sales. Let me make this a little bit bigger for you. So if you take a look at existing home sales, the median price of $417. Now this is nationwide. It's down 1.1% month over month, 3% every year. But remember, that is not appreciation. Let me say that again. That is not appreciation, my friends. That is literally the middle of the middle price. Half the homes sold above 417, the other half sold below 417. That's all that means. Existing home sales fell 2.5%. month over month in August, but this captures contracts signed up to 1.5 months ago. Does that make sense? That's when mortgage rates were much higher. So with affordability improving, transactions activity should definitely be showing improving over the months to come, because there's that 1.5 lag. That's good stuff here. All right, next week, big week. I'm going to make this bigger for you. We have Case-Shiller Home Price Index, FHFA Housing Price Index on Tuesday. That, my friends, that does measure appreciation of homes, so that's important. On Wednesday, we have mortgage apps new sales. Thursday, GDP, initial jobless claims, pending home sales. And Friday, good old Friday, PCE, the measurement of inflation. That is going to be a market mover. Speaking of which, market movers, if you're out there looking for a home and we haven't talked, or if you're thinking of refinancing, we haven't talked, let's do a hopes and dreams conversation. During this conversation, there's going to be no credit pulls, no documents, no applications. It's just going to be me and you and your family strategizing using my 20 years of experience. Please use it. I've been doing this so long. All I want to do is save you money. That's my goal, to save you money. Click that. Let me show you how you can save money on a mortgage, and we're going to make your dreams possible. Paul Obrantz, Clear to Close Brokers. That's your Friday